Hey everybody, today I'm going to talk about the 5 cheapest and best stocks on the TSX that you can buy and add to your TFSA today. These stocks either have a lot of upside, pay a great dividend, or both. So starting at the number 5 spot, I've got Alimentation Couche-Tard. So this is the company that runs convenience stores, Max, Circle K. It's been a phenomenal growth stock over the years. And what's great about it is it's really cheap. Price to earnings ratio of just 18. So it's a fairly decent multiple for a good growth stock. And it's a really huge business. So if you look at its footprint, 16,700 locations around the world, 29 countries and territories, and obviously a huge presence in Canada and the US, 2,100 and change locations in North America. If you look at Europe, about just under 5,300. And then in other parts of the world, over 2,000. So obviously still a lot of markets that I could penetrate and expand into. So it's a really fantastic growth stock to buy. There's a lot of good value for this stock to just buy and hold. And Couche-Tard over the years has done really well. If you bought the stock 5 years ago, you would have doubled your money almost at this point. So a really good stock to own for the long term. Still a lot of growth and a decent valuation for sure. In at the number 4 spot is Enbridge. So Enbridge is the pipeline company in North America, really safe oil and gas stock to own. I know a lot of people aren't crazy about oil and gas stocks, but Enbridge is not your average stock in that sense. It has been a bit volatile of late just because people have been bearish on oil and gas stocks. But one of the great things about Enbridge is that right now it's paying a huge yield, 7.5%. In the past, it's been around 6%. So this is normally a high yielding stock, a really solid one. PE ratio of 17. So another decently priced investment. What's also really great about Enbridge is the stock is fairly consistent. So if we look at its 2023 earnings numbers, adjusted earnings of $5.7 billion compared to $5.7 billion in the previous year. So incredibly solid. Another stat that is pretty awesome is that it says it's hit its financial guidance for 18 straight years. That's really impressive. And again, underscores its stability and predictability. So it has a lot of long-term contracts. The pipeline business is fairly stable. And even if you think electric vehicles will take off, or there's going to be a transition away from oil and gas, it's still going to be a process that could take, decades before that happens. And in the meantime, there's still going to be significant demand for oil and gas. So this is still a great stock to own with a high yield and a fairly low price. It's a really good stock to buy. In at the number 3 spot is Bell Canada, BCE. So this is a solid telecom stock. I mean, whether you love or hate the company, it's a reliable market-leading stock that you can invest in. It's been falling of late. It has been, I think, primarily due with high interest rates, inflation, and the fact that there hasn't been a whole lot of growth of late. But this has been the story for most telecom stocks in general. Whether you're looking at Verizon or AT&T in the US, they've been down just because telecom stocks in general normally do well as income plays. And when interest rates are high, people have more options. They can go to other investments, whether it's bonds, putting money in the bank, other places that they can get a higher return, or not a higher return, but a high return without putting their money at risk into equities. So one of the key things that I like about BCE is that normally the stocks are around 60 to 65 range for years, even above 50 at least. Right now it's at 45. So a really depressed price. And I think once interest rates start coming down, you'll see the stock start to rally just because it is so undervalued. So looking back at the summary page here, PE ratio of just under 20, and the really, really amazing thing is that the dividend yield is astounding at almost 9% right now. And over the years, BCE has increased its dividend by 62% over the past decade. So a really good dividend growth stock. If worse comes to worse and the economy slows down, goes into a recession, then the worst I could see happening is maybe they slow down the rate of their increases or they stop them. But even then, you still got a 9% yield. So it's a pretty good dividend stock to put into your TFSA. In the number 2 spot, I like Shopify. So Canadian e-commerce giant. Shopify has been a fantastic buy, but it's followed a pattern of many tech stocks in the U.S. where it had that big pandemic fueled boost, and then things went all downhill in 2022 and 2023 when there were concerns about inflation, high interest rates, all those things to sort of halt its growth prospects. But as you can see, it's still nowhere near the levels it was at in 2020. It was over $100 a share. So this is a stock that has a lot of potential. If you look at its valuation metrics, they aren't, the PE ratio is inflated because obviously this has not always been a profitable operation. But if we look at their statistics, we've got the PEG ratio. So this is based on the 5-year projected earnings growth. So with a PEG ratio, anything close to 1, ideally less than 1, the better of a value it is for the long term based on how much growth analysts expect from it. So if it's at a PEG of 1.1, that's fairly low. It's not below 1, but it's pretty close. A lot of stocks are well higher than that, 2, 3, 4, 5, even higher. So Shopify is good value. What I really like about it is that last year it was partnering with Amazon and was able to use, merchants are able to use Amazon's Buy with Prime, which is the first time that's been possible. So the fact that it's no longer seeming to having to fight with Amazon directly, and that they're going to be able to tap into their fulfillment network and go together, I think that's a really good catalyst for Shopify that should help it drive more growth. So really good time to buy Shopify. It's been rallying a little bit, but there's still a lot more upside, I think, to go, given that, again, it's still right under $100 now. So there's still a lot more upside, I think, that it can go. Again, 2022 is well over $140. So still a lot of upside, I think, once things get going and once the economy starts to rebound. It may take a while, but this is a good long-term play. And with a lot of potential gains you can make to put in your TFSA, there's definitely a lot of incentive to hold on to Shopify. And my top stock to put in your TFSA is Toronto Dominion Bank. So TD Bank is a really solid bank stock that you can realistically buy and hold forever. So it's been falling since 2022 with interest rates rising, again, concerns about the economy, all those things. So all those things have weighed on TD Bank, but this is, a fairly safe investment to hold on to. I can't think of a safer stock you can own on the TSX. Toronto Dominion is one of the top banks in the country. It's got a huge presence in the US, so it's got some good diversification. And right now it's, you can get it at a bit of a cheap price, PE ratio of 13. And what I really like about it is its dividend right at 5%. And so that's not common for TD stock, because normally its price is a bit better, its valuation is a bit higher. And to look at the past 10 years, its average dividend yield is about 3.8%. There have been brief times, well, I guess there was a bit of a prolonged period in 2020 where you could have got the stock at above 5% yield. But anytime you can get it at 5%, that's a darn good deal, just because TD is a really solid stock. And if you can get a 5% yielding investment that's also really safe and there's not really concerns about its stability, then that's a great option, because 5% yields usually come with some sort of risk. But in TD's case, it's just because the markets are overly bearish on financial stocks and the state of the economy. But this is a rock solid investment that I think is almost a no-brainer buy at this point, just because in the long run, TD is going to do well. Once the economy is in better shape, there's interest rates come down and there's more positivity in the markets, I think this will be a good stock. And again, getting it at a 5% yield could prove to be rare again, because once the stock goes up, that yield is going to come down and probably get back to around that 4% range. So could potentially be a steal of a deal. So with these 5 stocks, really good thing is with Couche-Tard, Enbridge, BCE, Shopify, and TD Bank, you got 5 different industries, a good mix of dividends and growth. So I think these are the best stocks you can load up on and put in your TFSA right now.